Hi, everyone. This is Natalie Pace. In today's free video conference, we're going to be discussing whether or not we're having a Santa rally, what were the top performers so far this year, and you're going to be surprised to note that it is not the Magnificent Seven. What is 2026 going to look like? How can you protect your wealth and grow it? Should you be worried about anything? As well as, are we headed for a crypto winter? All this and more, and we'll get started in just a moment. All right, so let's start with whether or not we are going to end up with a Santa rally. The high for the markets was actually October 29th. So we're pretty close to it. The total so far during this period since September 1st is about 5.2% annualized. And that's not great, but it's certainly not bad. We did, of course, have a big dip after October 29th, and now we have recovered it. I would say that everything is with a great deal of uncertainty. If you watch the Fed Reserve press conferences or read the minutes or listen to all the economists and analysts like I do, what I keep hearing over and over are two things. One is a great deal of uncertainty, and another one is that the word bubble. So let me show you what I mean when I talk about the word bubble. I'm going to go ahead and share the screen so you can see. This is one measure of where we might be in a bubble. This is a called the CAPE ratio by Robert Shiller, Nobel Prize winning economist. And as you can see by this measure, you look at the blue line here, it's a 40. And the only time when the price earnings ratio was this high, this is very high, was the dot-com recession. It's higher than it was in the Great Depression in 1929. So when people talk about bubble or elevated equity prices, that's what they're talking about. And when we had that very, very high bubblicious scenario in 2000, between March of 2000 and the low of November of 2002, the NASDAQ Composite Index dropped 78%. It took 15 years to recover. Now, you might say, but we have AI. Well, back then we said, but we've got .com, right? Now, of course, these are very exciting developments. And the same question with AI was the same question with .com back in the day. Does it pay money? Is it going to make our GDP grow? The truth is that all of the investments in AI and data centers have really been the surprise this year. So we were expected to have even more slow growth. It's still expected to be pretty slow growth, just 1.8% GDP growth year over year, but that's still a little bit better than what it was projected to be. And it's really all about AI. But we don't know yet how much that is going to be monetized. It's a big cash burn for a lot of companies. Okay, so the positives on whether or not there will be a Santa rally is that the Black Friday, so the consumer is staying strong. We had a record Black Friday. It was 11.8 billion for the US, it was 79 billion worldwide. The other positive is the December 10th. It is expected, but not guaranteed, to be a rate cut. Now, I will say this. On October 29th, we had a rate cut and the stocks went to an all-time high, but then they retreated. So the other problems, which we're now going to talk about, are the reasons why. Valuations. So very, very bubblicious. Credit risk, anybody who's been walking around their neighborhood, especially on the streets where we used to have a lot of shops, you know that there's certain areas of our economy that are really falling behind. Commercial real estate is kind of the real sore eye on all of that, but there are others as well. And we're going to look at the best performers and the slowest performers. And the other negative is 1.8% GDP growth with those lofty valuations is kind of a mismatch. So we just saw Robert Rubin, who's the former Treasury Secretary, former co-chairman of Goldman Sachs. He was saying, this is a mismatch between what's really going on and the market. And that can happen. What happens in bubblicious times is that people buy into the flashy ad, AI everything. Oh my God, it's going to change everything. It's going to save everything. And it truly, robots did save the economy this year. But we have to pay for it. The same thing. They said .coms, everything's gonna come. And yes, we now, we shop online instead of going to malls. That did eventually come to pass. But anybody who tried to shop online in 2000, when you still had dial-up connections, you know that oftentimes you might fail, right? You might not be able to actually even load up your cart. No, certainly couldn't pay for it. And then, people were afraid to pay online. So there were all kinds of issues that had to be worked out. So let's take a look at some of the best performers so far. I'm going to let you go ahead and take a look at my updated chart. Hang on, let me throw it up here for you. Okay. So as you can see here, the best performers were surprising because it was not the Magnificent Seven this year. So the Magnificent Seven is performing very, very well. It's performing better than the S&P 500, and it's responsible for the S&P 500 performing so much better than the Dow, right? So if you don't have large cap growth, specifically technology and specifically the Magnificent Seven, then you're really performing at half of the speed of the market. So that's one of them. Now, also, those of you that are using my pie chart system, that we always have four hots, and we're also using value replacements. And those are some of the best performers this year. So I do want to take some bragging rights here. We said lean into silver because it had even more room to grow than gold did. And silver has been a far outperforming gold. We did, when we were talking about this, we identified first majestic silver because that one actually mints silver coins and they had a lot of year-over-year sales growth. And that is really one of the best performers this year, even better than NVIDIA, right? If you look on this chart. McEwen Mining is doing really well. And that's because gold is doing well, but also copper. Another one is Peru is one of our value replacements. And this one is one of the top performers. But also, as we talk about with value replacements, there's so much credit risk in the US. We have a lot of debt. So that's usually concentrated in those value funds. And so we have been going outside of the US with our value funds. Peru for the mid cap value, or Indonesia, Australia for the large cap, and Ireland for the small cap. And all of those are having a much higher dividend, so more income than you're going to get from the US equivalent of that particular fund. And most of them are far outperforming it in addition to that. So I'm really proud of the performance of the things that we've been talking about in our retreats. And you can kind of check them out here. Feel free to take a screenshot, or you can email info@nataliepace.com. I'm happy to send you that performance chart as well. I'm going to show you a couple of different blogs that you want to also read with regard to this. So, I did update that performance chart fairly recently in a blog. The S&P 500 doubled over the last 5 years. I'm going to have a link to it in the description page on YouTube that you can easily link to. Also, let's see what this one is. Will there be a Santa rally? And the interesting thing about this is that this was written at the beginning of October, right? We were saying at that time we didn't know whether or not we were going to have a Santa rally. Of course, stocks did go higher and then they went lower and now they're back pretty close to where they were. But then we were talking about that there are risks and they aren't predicting a recession, but at the same time, the stocks were already very lofty, right? So I wouldn't just count on everything always going up. Remember that your best protection against a downturn is keeping a percent equal to your age safe. In our sample pie charts, we are actually overweighting 20% safe because of all of the issues that I've already outlined and a few more. If you would like to update your or personalize your own pie chart, we do have free web apps. You can email info@nataliepace.com for those links. Um, yeah, so we talked about the best performers. Now, the second half of this is that one of the funds, or two of the funds that we list as a potential hot for people, are Bitcoin and Ethereum. the best way to invest in Bitcoin and Ethereum isn't just to say, oh, I think the dollar is going to become worthless or we're all going to be using BRICS currencies. And there are reasons for that. And I have blogs on that. So email info@nataliepace.com if you want to drop down the rabbit hole on all of that. But I did do a recent crypto blog, and it covers a lot of things that I think are very important for you to be considering. Are we headed for another crypto winter? Now, when I named Bitcoin as my company of the year or investment of the year in 2024, Bitcoin outperformed by far. 2023 more than doubled, 2024 more than doubled. But one of the things we were saying is that you want to use it as a hot slice or two rather than bet the farm. And there are many reasons for this. It's a very volatile one. The other reason is that it helps to put you on the right side of the trade because if you buy a slice of Bitcoin and it does double, then sell the second slice. And that way you've kept the money. And if it goes down, instead of going through a really hard and long crypto winter, you can buy low. So it helps to keep us on the right side of the trade. It helps us to make the right choice. It takes the emotions out of it. Remember, whenever you are doing your rebalancing, which should be once, twice, or three times a year, take it off the brokerage statement and put it into an Excel file or a Pages file that could give you a pie chart so that you are comparing a pie chart rather than those red light, green light, or plus minus signs that you see on brokerage statements, which are always jacking our emotions on the wrong side of the trade. It's really important. The pie chart system works like magic once you start using it properly. It's not that difficult to use properly. But I want to point out a few other things here. So, in my blog back in 2024, what I indicated is that there's a very strong correlation with what we would call a Bitcoin halving event. Now, you don't have to know all the ins and outs of that, but if you'd like to learn more, just do a Google AI, and AI will explain what a Bitcoin halving event is for you. But basically, what we were seeing in the historical trend is that at the point of the Bitcoin halving, 1 year later is when Bitcoin hit its high. And 2 years later is when it went into a crypto winter. And we are absolutely seeing that trend play out so far. It doesn't mean it'll continue to play out and go all the way into a crypto winter, but Bitcoin is already down 27%. The halving event was April 2024. 1 year later was April of 2025. The high for Bitcoin was October 6th. So it was just over about 2 months ago, right? And since then, it's already down 27%. Now, again, if we are true to form, then by next April-ish, we could be in a severe crypto winter. And what do I mean by severe? Well, take a look at this. Goes pretty far, right? The last time this occurred, it went from 70,000 down to 15,600, and it took a couple years to recover, right? And by the way, there are many reasons. If you have a lot of money, like if you weren't using the pie chart system and slices, if you were just betting a boatload of it, then when your net asset value goes down that far, you could be in serious trouble. Your FICO score plunges. If you have leveraged yourself, the debt collectors will call you incessantly. We see mental health problems. So it's not like you can say, oh, I'll just buy and hold and I'll live through all these ups and downs because it always just goes up. Yes, it has always just gone up, but that is not always going to be the case necessarily. And it's very important to realize that nobody's using crypto at this point as a currency. Now, are we doing digital currencies? Absolutely. Like, I don't know, it's really hard some places to pay with cash, but it's not crypto because you can't have a currency that's valued at 69,000 one month and 15,000 the next month. That's the whole point of being able to pay for things is that that value is going to be there tomorrow and a year from now. So I do want to make sure that anybody who's doing crypto is aware of the halving event trends, is aware that the next, if we go according to the historical trend, by April of next year, we could actually see much lower prices for crypto, and it drags down everything. But also, I want you to be aware that we have a few other things that you should be looking at, including how you can avoid capital gains taxes and how you can avoid crypto scams. So, this is another blog. Again, I'm going to be linking to it in the description on our YouTube channel. Now, I did have a couple of other quick questions that I want to go ahead and answer that were emailed in. And I want to remind everybody that that is one of the perks for our all access passes, is that if you have a question, email it to me and I'm happy to answer it in our video conferences. Please email it at least a week before the video conference. Don't try to slide it in under the wire, half hour before. So one of them was this particular person wants to prepare for retirement. And I think that's a great topic for a master class. So I will be doing that in between now and whenever we can schedule that, which hopefully will be over the next 6 months. If you want to prepare for retirement, some of the things that you want to do are to start figuring out how many bills you can toss out the window. So we talk about that a lot on day 3 of our financial freedom retreat. Also, in the private coaching, we can take a look at what it is that you're going to be earning. We can look at it through the lens of the Thrive budget. You could also read the ABCs of Money 6th edition, really focus on the Thrive budget part there. Make sure that your Thrive budget that you're basing it on is your new salary, which is chances are it's going to be lower than it was when you were an income earner, unless you get creative. I'll give you one example. There was an executive who retired and she had a big house, and it was oceanfront in Southern California. And what she did is she rented out the big house. She had a pension from her job in addition to her 401k. And she got a little place on a golf course because she liked golf and she wanted to travel. So now her income is actually pretty close to the same because of the rental of the big house, which she didn't feel like she needed because she would have more joy traveling 6 months out of the year than living in the big house alone. And so there are creative ways that we can actually increase our income as we head for retirement or in retirement. And they're not really necessarily found if you're just going to a retirement coach. Again, all of the strategies that I teach in the ABCs of Money, from the Thrive budget to investing, these are things that I had to learn on my own because the books didn't show them right. So I would just say whether you do it through private coaching or let's definitely schedule that master class coming up. Definitely, this is something you want to prepare for, but one last tip I'll say is that the biggest expense in retirement is healthcare. So this is something that actually I want to speak to our Gen Z and millennials. If you're working and you're spending an arm and a leg on healthcare, health insurance, and you're healthy, you need to look into health savings accounts with the highest deductible because in addition to all the benefits of, maybe saving thousands in health insurance premiums, you have a tax credit, you're building up your own health retirement account. And that is going to be the biggest protection for you in retirement, since healthcare costs are really what usually send people into the doghouse in retirement. So we can talk about that more in private coaching or in the masterclass, which we'll schedule. Keep me to it, Grace. Also, people wanted to know about McEwen mining. This particular person, I would just say for most people, you shouldn't be investing in individual stocks unless you're really willing. It's a different strategy. When you're using our pie chart system, rebalance once, twice, or 3 times a year. That should be in funds because the funds protect you, right? If one company doesn't do well, the rest of the companies in that fund should hold it up for you. McEwen is doing great though. And the reason for that is that gold is doing great, silver is doing great, and so is copper. So I would strongly suggest that I just had an interview with Rob McEwen. He was super excited. We did an interview with him in the pandemic, and even though he was honest, you could see he was really beaten up. That was a time when it was really hard. Of course, gold did come back. So there's that. Then interest rates. I think the biggest thing about interest rates is that they're not expected to go down to zero, which is where they were for that very extended period after the Great Recession. So I wouldn't say that interest rates are going to be the holy grail in our economy. We still have a lot of credit risk and duration risk. So people think that interest rate cuts are going to fix everything. And we have too much other things going on that need to get fixed. They will help. Yes, but they could also stoke inflation. We did have that scenario where the inflation got stoked and the economy slowed down. It was stagflation, and they had to actually raise interest rates a lot. There are people that remember when it went to a 20% Fed fund rate in 1980. It's been a long time, but I'm just saying is that it's not the holy grail because we still have the specter of inflation. I don't want to give you an entire tutorial on economics, but what I would say is this: act your age, have a percent equal to your age safe. Consider overweighting safe because there is a lot of peril out there. Not all of it can be fixed by interest rate cuts. And diversify small, medium, large value and growth, four HOTS. That's only 10 funds. Most people with 18 pages of a managed brokerage account, they still only have maybe three slices. They might have large cap value, large cap growth, and maybe some small caps. So, and by the way, they might also be losing money on the paper losses on the fixed income side where people aren't experiencing paper losses using our strategy. And by the way, that's since the Great Recession. So, we've been spot on that one. So again, call 310-430-2397 or email info@nataliepace.com, and just let us know what you want the next video conference to be about. Let us know if you need links to anything. Let us know if you'd like to register for our next Financial Freedom Retreat. It is the New Year, New You Financial Freedom Retreat. For those of you that have attended a lot of classes, we are doing the Rebalancing Masterclass the Saturday before the retreat. You do need to have one retreat under your belt before you can do the rebalancing masterclass, but that one will help you because we will show you how to evaluate where all those stocks go that you might already have. And to develop your own pie chart, we'll give you an Excel file that has it's already programmed, so you can just go ahead and put in the numbers there. We'll just set you up so that you can become autonomous using our pie chart strategy, which is a time-proven 21st century strategy. But you do need to have one retreat under your belt before that will make sense to you. All right, so thanks again. I'm going to go ahead and stop it here for a second. Okay, so we did have one person ask a question live that's actually pretty good. She was saying, okay, if want to buy a Bitcoin, it's like still $97,000 or 92. I don't have $92,000 for one coin. Now, if you bought it on Coinbase, they are selling you a fraction of that Bitcoin. But there are other ways to buy into cryptocurrency. And by the way, the other ways might also help you with the capital gains exposure. So, as an example, Coinbase doesn't, they may have fixed this already, but as the last time I checked, they did not offer retirement accounts. So, if you are able to put your crypto, again, a slice, it's not the whole banana, it's not the whole farm, a slice in your retirement account, if it shoots the moon and you capture gains, there's no capital gains taxes on it, as long as you dot all the I's and cross all the T's. So let me show you how you can do that because you don't have to, it's not a $92,000 investment. So there are two, and again, don't just Google it, get Bitcoin Fund, because you might end up with I just started my fund yesterday.com with Mr. Fraudster. So be very careful, right? You don't want to just go for the first thing that you see, which is going to be a sponsored ad and could in fact be a scam. So I use iShares because it does have a double A minus credit rating. So there's a Bitcoin one. and there's also an Ethereum one. And as you can see here, this fund, which is now a Bitcoin Trust ETF, exchange traded fund, it's only $53 a share. So, one last tip. Oh, let me show the Ethereum one. So, the Bitcoin one is IBIT, the Ethereum one is ETHA, and this one is 2366 a share. So, a lot of retirement accounts don't allow you to buy fractional things. So it is important that it is affordable. And the fund companies know that, and that's why they make it a price that you can afford, right? Now, the other thing I wanted to say is that if you don't own it, even though it's 92,000, it's still very high priced. If you, especially if you think that in November of 2022, it was only 15,000. So dollar cost average into it. All right, it's just a lightning round question, but happy to answer it. So, another question that came up, which is a good one, is that this was a couple of newsletters. It looks like their technical traders are saying that they think that 2026 is going to be a banner year. I think that you want to mitigate that with some of the things that I am reading. I'll show you a couple of things. In fact, let me go ahead and pull them up. So one of them is Fitch. This just came in. And the title of it was Booming IT Investment Cushions US Slowdown. But you'll see the word bubble throughout this all very, very, prolifically. Bubble risks in the financial system. I would also tame my expectations with a nice reading material of the Federal Reserve Board Financial Stability Report, which is always something that can put you to sleep, but if it doesn't scare the heck out of you. So let's see. Hang on. I'm going to try to see. I'll link to this too, by the way, so that you guys can do that if you wish. See if this is the most recent one. It was just released a few weeks ago. Yes. So I would read that, and that'll sober you up a little bit. And then here was the Robert Rubin quote. There's one date you want to keep in mind, October 19th, 1987. That was Black Monday. Google it. When the markets were out of sync with reality, out of sync with reality. The timing is impossible to predict, and it is possible we can just keep doing things that are unsound, but that seems to me a very unsound bet to make. That was yesterday, former Treasury Secretary. So, what I think that we have to be careful of, couple things. First thing is newsletter people have to make predictions, right? Like, I mean, I'm not making a prediction, right? I am telling you overweight safe in our sample pie charts. You do you, you're the boss of your money. I have many reasons why I am suggesting in our sample pie charts that we overweight safe. Does that mean that the markets will not have a banner year? No, because in the short run, it's a popularity contest. In the long run, it's going to be fundamentals. So at some point, we do have to come back to reality. And right now, we're very far from reality in terms of valuations and a great deal of other things. So next year, the GDP is not expected to be great. I think it's 1.8%. That's slightly lower than it is this year. As you can see, any scare that we have, the markets can drop 20% very short period of time. So we did see that it touched down minus 20% on April 8th this year. Yes, things just kept going up. But another thing I want to say is that we basically haven't had a recession since the Great Recession. In the
Right.
pandemic, we would have had a very big recession if we had not printed up $5 trillion and gave it to everything with a pulse. That's not going to happen in the next recession. We can cut interest rates. There's a lot of things that we can do, but they may have to let us come down to reality. And that happens. There are times when the Federal Reserve just kind of says, we kind of have to let a couple of companies go bankrupt. So far, that hasn't happened because of largely central bank policy and financial engineering. So I would just say, and also historic charts, they don't have a great track record. The person who wrote the book on options trading, who's big technical trader, Nobel Prize winning economist, had one of the biggest hedge fund failures in history. You can Google Myron Scholes and what I just said so that you can discover that. So I would go more with fundamentals and proper diversification. Where you want to take on risk, I would say is what do you think is hot, right? Take on risk there in measure. And also, if you really think that it could, in fact, be a banner year and you're willing to take on that risk, don't overweight safe. But get close to keep a percent equal to your age safe, proper diversification on the at-risk side, and then know it's safe on the safe side. All right, I'm going to say rebalance once, twice, or three times a year. Oh, sorry. All right, gang. So that's it for today's free video conference. Again, subscribe at youtube.com/Natalie Pace and at Substack so that you're always alerted to what we've just posted. Again, I had two exclusive interviews a couple weeks ago, one with a blue chip specialist, another with Rob McEwen, who is a 40-year gold industry veteran. So not just about McEwen mining, but about gold, silver, and copper in general. He's very experienced in that. And I also want to point out a couple of other opportunities. The New Year, New You retreat. Again, it's January 17th through 19. Families who come together get the best deal. You can pay retail for the first one and then half off for the second person. If you're bringing a teen or a college student, it's only $99 to bring them. And I'm also preparing for our Restormal Royal Manor House retreat. We have to book it a year in advance, so it may seem like a long way away, but when you're going to do an immersive adventure of this magnitude, you want to plan for it in advance. And we have meetings every quarter to help us get prepared for it. So as you can see, this is the Restormal Manor House. It's a private estate. It's there's nothing around it except for, the royal family's holdings. There's a castle on the hill that they own that was built, I think it started in the 1400s. And this is an exclusive event that I'm not positive I'll do again. I do it every other year, and 2027 may be the last year. Just not sure. But I would say I wouldn't bet that I would have one in 2029. So thank you again for joining me. Remember to visit nataliepace.com and be the boss of your money. When you learn the life math that we all should have received in high school, everything changes. Thanks again.